Here we go. This is the 5/30 July contract that expires next week. Now, when MMTs were learning that yesterday's highs, that the 540 put was totally the opposite side. They learned that the high of the contract here, for the July contract here, was 27.50, and that we were, when we were buying them down here at $1, if you had 10 contracts, you made $26,000, but you had to be selling up over here. They were too inflated. When you go over here now and you take a look here at the 540 put, which was below the market because Google put a high in on the daily chart, that these were totally deflated down here, as I said in the other videos prior to the trade being taken, that 1260, that these were deflated. This is just a July contract. When the put side was inflated up here, it was time to buy the calls over here, and the puts came all the way down and the calls went all the way up. We master market tops and market bottoms in indexes and equities and ETFs, bull, bear, whatever you want to know it. And our analysis is always before the move happens because it's pointless otherwise and it doesn't make money otherwise. And we know it. And what MMTs learn in the school is a master market maker. When I was at the bottom, when these were at the top here, they were inflated and they took all the premium out of the put, and then that call raced up with the 9-day bull rally in the equity itself. So let's take a look here. Here is the daily Google chart. Yes, this was the time to get on the call side. When we ran into that 100-day simple moving average, and I did a live video, that when you were down here at the very low of the daily percent DS, 10.72%, to 86.61% to resistance, you selling those calls, because when Google was putting that bottom in to go long and it had a 9 good day rally with the broader markets, is that at the same time that this bottom was put in here, the bottom on this call, which is a 540 call, way up and out of the money, was to be bought. And bam, you went higher. Now on the flip side over here, when the bottom was put in Google over here, that meant that the put option was so inflated that it would come down and lose all its value. So once again, when it comes to call and put options and trend cycles, yeah, it was a great move there. They never sold them, no. And they're lower than what the puts were, lower than what they were over here. And they were $70 a contract. And they took them down to $12.50 and they had a big gap up. That's just that contract. If I go and show you the other contract that we were trading, this is a 530 call that expires today. You can see that it was $20 yesterday on the high, and you can see that today the very low right here, it's in the video, was $1.50 where we had orders out, and you know, before the market opened. Did we not, Rick Goley? Did we not, Leo? Did we not, Will? Before the market even opened, and 17.19 was the close, but they expired today, but they were inflated. Now, if I go to the 545 put that expires today, it was so deflated right here that this 545 July put was so deflated here, that it was so deflated. The July 545 put that expires today, that's this one. Look at how cheap it was. Look at how cheap it was. It was $1.50, man. You had to buy this at $1.50. That was the low. Look at the high. Look at what happens inflated and deflated. And look at the equity using today's expiration and next week's expiration. And why that 546 was a major resistance level on the daily 100-day chart. And you MMTs have learned how to turn that pendulum swing. You learn how to get on. That was an exuberant, great move. And this here was such a deflated move at $1.50. At $1.50. So we made money on the calls. and taking part of the profit and putting it, see, the calls have the great breakout. We made a lot of money on those, and then taking some of that profit and spending $2, taking $2,000 of your profit, you can't lose money. And today, look what happens. And today's expiration on this contract. Okay, this one expires today. The other two in the video are next week's contracts. Learn how to hedge risk. Learn how to get on the other side of the inflated bull to the deflated bear, and then understand the daily overbought chart. Understand the declining 100-day simple moving average at resistance with the gap down reversal. The 50-day moving average will be at 520. Google reports earnings next week, and it ran to sell the news and the big gap down and understanding overvalued calls and devalued, deflated puts, taking some profits from this trade, putting some of those profits in the deflated put, and you get these rewards. You could never have lost money by doing it the SMF way. Bottom line, let it be known.